What's up, everybody? This is Sunko, the Korean bro. Today is 2022, December 27th. Let's read articles, okay? The one article that I'm going to read first is let's see. Okay, two e-commerce stocks you can buy and hold for next decade. 3 reasons Amazon stock could soar in 2023. Supercharge your passive income in 2023 with this ultra high yield dividend. Will Roku bounce back in 2023? After leading the S&P 500 in 2022, here's why energy stock could continue to soar in 2023. Four unstoppable multi-bagels to buy in 2023 and hold for next decade. Okay, we got a lot of articles tonight, so let's read it one by one, okay? 2 e-commerce stocks you can buy and hold for next decade. And they are e-commerce stocks largely underperformed 2022 due to difficult comparisons and macro headwinds. Shopify is the clear leader in e-commerce software and should benefit from long-term growth in the sector. Etsy has carved out its own profitable niche in handmade and vintage items. E-commerce still has a bright future ahead of it. E-commerce took a breather in 2022 as difficult comparisons with 2021 and macro headwinds cooled off growth across most of the sector. However, that doesn't mean the high growth days in the sector are gone for good. Technological innovations like augmented reality should help spur adoption in areas like home furnishings, and delivery speed will continue to improve as well. Meanwhile, other external trends like remote work should also support the growth of e-commerce. Yeah, we in the future, people will work remotely, and that will lead e-commerce business. According to the Census Bureau, which tracks retail sales, e-commerce makes up less than 15% of retail sales in the U.S. Even after years of double-digit growth, it only makes up less than 15%. Not 50, it's 15. This shows there's still a huge opportunity. E-commerce is an even smaller percentage of retail sales in international markets. If you're looking for e-commerce stocks to buy and hold for a long term, keep reading to see 2 great candidates. One that I'm going to cover is Shopify. From what I know, Shopify is the company that helps small and mid-sized business to have their own website and have their business online. Shopify has made it this process really easy so that these CEOs of a middle and small size companies can focus on their real work, not focusing on, they don't have to pay much attention to like trivial works. They can only focus on what they think is important. And Shopify, the current price is 33.71, and it's been growing rapidly. Okay. Amazon has dominated e-commerce sector since its early days and owns roughly 40% of US market share thanks to its first-party business and third-party marketplace. However, there's a big gamut Amazon services, and that's where Shopify comes in. If you're a small or medium-sized business and you want to sell on your own website, Amazon can't help you. Shopify has increasingly become the de facto solution for these online retailers. It's even attracted Fortune 500 companies that want to quickly deploy it on e-commerce site. So those who want to deploy an e-commerce site, they go to this website to have their own business. Hmm. And they make it really quick, they make it really easy. Shopify provides a suite of software service for business, including web design, analytics, marketing, logistics, and payments. Its leadership in e-commerce software has driven tremendous growth for the company. As you can see from the chart below, revenue has soared since the company's 2015 IPO. However, the stock has plunged over the last year as growth has slowed down and profits from a year ago flipped back to losses. Hmm. The stock has plunged over the last year as growth has slowed down and profits from a year ago flipped back to losses. That set up a buying opportunity for Shopify. The stock looks reasonably priced at a price to sales ratio of less than 9, and it's still posting solid growth in a difficult environment. For example, the company said gross merchandise volume jumped to 21% to $7.5 billion over Black Friday weekend. The company said gross merchandise volume jumped to 21% to $7.5 billion over Black Friday weekend. Shopify's growth should accelerate once comparisons get easier and macro headwinds fade. The company is also in a strong position because it faces relatively little direct competition. It's much larger than rivals like BigCommerce and WooCommerce. So like they're dominant in terms of making um, middle and small size companies to have their own website easy. They're like a dominant in this area. So they're like different from Amazon because they help um they're more like helping people have their own website, but Amazon don't do like that. So if you are bullish on e-commerce over the long term, Shopify is a great way to get exposure to the sector. Okay, let's read two more articles about Shopify. Okay, before we move on. Two magnificent growth stocks the smartest investors are buying before the next bull market. Um, Karthik Sama has sadly added to his stake in Shopify this year. Karthik Sama, who is Karthik Sama? Okay, Karthik Sama, both of directors. The billionaire hedge fund manager in the spare bedroom, David Solomon's alter ego. Okay. Hedge fund force. Karthik Sama. Sama founded the hedge fund SRS Investment Management in 2006 after 5 years at Chase, Commerce, Tiger Global, and now manages $10 billion. SRS owns 43% of Avis through common stock and equity swaps. Sama has served on the car rental company's board since May 2020. Indian Emir who came to New York to get his master's at Princeton, spent 3 years as a consultant at McKinsey. Has Sally added to his stake in Shopify this year? David Shaw more than doubled his stake in the trade desk since the first quarter. Okay. Hedge fund managers with a history of achieving market-beating returns are buying these growth stocks, even as the S&P 500 also accomplished deep into a bear market this year. And some of the smartest hedge fund managers out there weren't dissuaded and kept buying growth stocks eagerly. Karthik Sama of SRS Investment Management took a stake in Shopify in the first quarter, and he built into his fifth large position by the end of the third quarter. Meanwhile, David Shaw of D. Shaw Company more than doubled his stake in the trade desk since the first quarter. So, what makes Arma and Shaw smart? The funds these two hedge fund managers overseas both outperformed the S&P 500 over the past 4 years, putting them in rarefied air. Individual investors should follow their lead and buy these two growth stocks before the next bull market. Here's why. Okay, once again, Shopify, okay? High inflation hit retailers from multiple angles this year. Rising prices simultaneously slowed consumer spending and turbocharged operating costs, putting pressure on Shopify's top and bottom lines. The third quarter revenue increased just 22% to $1.4 billion, and the company reported an adjusted loss of $0.02 per share, down from an adjusted profit of $0.08 per share in the prior year. But the tough economy is a temporary problem, and Shopify is in great shape to re-accelerate growth when inflation moderates. The bull case is straightforward. Shopify simplifies every aspect of e-commerce, from marketing and inventory management to payments and order fulfillment. So they make it really easy. So marketing, inventory management, payments, and order fulfillment. Its software integrates with online marketplaces like Amazon and social media like Meta platforms, Facebook. It also syncs with brick and mortar shops and direct to consumer websites. So it's not it's not like they can it's not like the people who owns business can do business within this Shopify website. They can also have business linked with another website, such as Amazon Meta platform. They give Shopify an edge over retailers like Amazon and Walmart, and its robust product offerings propel the company to the forefront of the industry. In fact, Shopify is the most popular e-commerce software vendor in terms of market presence. And user satisfaction, according to software research company G2. That brand authority should help it capitalize on its large addressable market. Retail e-commerce sales are forecast to increase by 14% annually to reach $15 trillion worldwide by 2030. That brand authority should help it capitalize on its large addressable market. Management So they got also brand power, okay? And it's expected that retail e-commerce are forecast to increase by 14% annually, okay? Management outlined an ambitious growth strategy, part of which involves building a nationwide fulfillment network to democratize logistics for D2C businesses. And they even have their own business strategy. The Shopify fulfillment network will support 2-day delivery to buyers across the US, meaning sellers will be able to guarantee faster shipping across multiple sales channels. No other e-commerce company offers that flexibility. D2C, social media, and online marketplaces. So from sellers' perspective, they got a lot of options. D2C, social media, and online marketplace. And no competitor have that kind of options, but they have it. Currently, shares trade at 8.4 times sales, still compared to the 3-year average of 35.5 times sales. That's why this growth stock is worth buying today. Okay. The fintech stock that should be avoided in the new year Shopify. Hold on. Okay. On the other side of the owl is an exceptionally popular fintech stock that should be avoided like the plague in 2023. I'm talking about cloud-based e-commerce platform Shopify, which provides an assortment of marketing and financial solutions for merchants, which is why it qualifies as a fintech stock. To be offering Shopify isn't your traditional avoid like the plague stock. It's not a poorly run company. It does have a potentially exciting future as a key player in e-commerce. As consumer shopping habits continue to favor the convenience of direct to consumer models, Shopify should have no trouble building its subscriber base, mm, which is currently dominated by small businesses. Earlier this year, Shopify estimated that its total addressable market just for small businesses was $160 billion. For context, the company is pacing $5.5 billion in sales for 2022. In other words, there's ample room for sustained sales growth. However, 2023 doesn't look as if it's a banner year for Shopify for a variety of reasons. Historically, high inflation has hurt the discretionary buying power of consumers, which adversely impacts the small merchants that Shopify's platform is relying on. Okay, I understand. I understand his logic. So, especially with high inflation, the people who are influenced the most are people who have small businesses. So, since Shopify's platform is rely on those people, they wouldn't have much profit in 2000 year in the year 2023. Okay. Furthermore, Shopify's focus on coach cutting is concern for a company that's been aggressively valued by investors as supercharged growth stock for years. In July, the company announced it would reduce its staff by 10%. Okay. After making an incorrect assumption that e-commerce uh, growth would continue to accelerate due to the pandemic. Even though coach cutting is right moving the current environment, it's a glaring admission that the company's supercharged growth heyday is over. Don't overlook growing competition from Amazon either. In April, Amazon introduced the word to buy with Prime. This brand new service extends the benefits of Prime beyond the borders of Amazon leading e-commerce marketplace. In short, it's a direct threat to the e-commerce payment model that helps Shopify generate a significant chunk of its revenue. So, uh, well, it's obvious that Shopify is dominant in banking or website business area, but Amazon is still a big threat because they're also categorized into e-commerce industry. Okay. Hmm. In Shopify's defense, it's not uh mom and pop shop that Amazon can simply waltz over. Nevertheless, Amazon has an army of more than 200 million Prime subscribers that could inadvertently eat into Shopify's pie. Okay. Well, there's still a threat. Threat listed here are Amazon and high inflation means mm, people like who owns small business are less likely to use uh, the service from Shopify because they don't have much investment on their hand. Okay. Mm. And coach cutting also uh, coach cutting. And you coffee sama, okay. Shopify. And the next one we have is Etsy. ETSY, Etsy. Okay. Etsy, like Shopify, Etsy has also found its own sector of e-commerce where it's protected from a competition with Amazon. Etsy's marketplace specializes in unique handmade and vintage products like jewelry, gifts, and clothes, and stationery that you can't get elsewhere. The focus, along with its marketplace business model, has given the company a strong competitive position. While it's also seeing growth slow this year due to the broader headwinds in e-commerce, the company remains solidly profitable with an adjusted EBITDA margin of 28% in its most recent quarter. The company has generated $367 million in free cash flow through the first 3 quarters of the year, or a 21% margin. As it continues to make updates and investment in its platform, recently adding image search functionality so users who see something like they can search with just a picture, which is especially useful when it might be hard to describe an item. It's also improving its ad experience using computer vision to serve more personalized ads. Ads estimate it's penetrating an addressable market of $466 billion for online sales of the categories it competes in, giving it a large market to grow into. Ads is acquiring other e-commerce platforms like Reverb, a musical instruments marketplace, Depop, an app for secondhand and vintage clothing, and Elo7, a Brazilian marketplace similar to Etsy. Etsy calls strategy house your brands and positions the company to grow beyond its namesake Etsy marketplace. So Etsy, the company is really concentrating on acquisition to strengthen their strong point, which is vintage and consumer-oriented goods. As e-commerce continues to grow and millionaires and Generation Z turn to authentic marketplaces like Etsy, the company should deliver solid growth over the next decade. Okay. 3 reasons. The cloud computing market is set to grow at an impressive clip. Amazon expanding advertising platform also offers great potential. Its e-commerce profits could rebound sooner than investors think. Okay. It's been an agonizing year for Amazon shareholders after surging during the early stages of the pandemic. Hmm. When store closures and other COVID related restrictions drove people to shop online, the e commerce giant stock price has backtracked in 2022. Following several quarters of slowing growth, Amazon shares are down a brutal 49% year to date. Yet Amazon is still one of the most compelling dominant businesses in the world today, and its long-term growth prospects are far brighter than its recent stock performance would otherwise indicate. The stock market tends to correct its mistakes, so these discrepancies are unlikely to persist. Here are three reasons why Amazon shares are poised to rebound in the year ahead. When people think of Amazon, they usually think about its sprawling e-commerce operations, but Amazon.com and sister sites are no longer the main sources of profit for the company. That distinction belongs to Amazon's Web Services. AWS is the leading provider of cloud infrastructure services. It commands a 34% share of the $217 billion market. That's more than its next two competitors combined. Cloud computing's curves performance and security profits, combined with rising usage of advanced technology like artificial intelligence, are expected to fuel the industry's growth in the coming decade. The global cloud market will exceed $1.5 trillion by 2030, up from $484 billion in 2022. According to Grandview Research, Amazon is likely to benefit from this growth more than any other company. Investors, however, have focused more on Amazon's warnings that AWS near-term growth could slow as businesses delay their technology investments due to fears of potential recession. But while the recession could dampen Amazon's results, any re-acceleration in AWS's growth rates could ignite a powerful rally in its stock price. And based on the rising long-term demand for cloud services, it's likely only a matter of time before this occurs. And after spending tens of billions of dollars to bolster its fulfillment network during the pandemic, Amazon can now provide one day and even someday same day delivery services for countless items. This benefit should help Amazon capture a larger share of global e-commerce market that's set to grow to nearly $7.4 trillion by 2025, up from $5.5 trillion in 2022, according to eMarketer. Will Roku bounce back in 2023? Uh, Roku is Kathy Wood's pick, right? Roku's financials are moving in on the wrong direction at the moment, but usage continues to grow as viewers gravitate from a connected TV to streaming. The business looks positioned for long term growth once the economy rebounds. Roku. Okay. The streaming stock is down sharply this year. Is this an opportunity or a warning? Just about everything that could have gone wrong for Roku in 2022 has. The stock has plunged 82%. It just touched another 52-week low. Revenue growth is expected to be negative in the fourth quarter. And after delivering a solid profit a year ago, the company has now lost $261 billion through the first three quarters of the year. While those data points might seem to indicate a broken business, Roku is in a better position than it looks. After the brutal sell-off this year, it's worth asking if the stock is a good rebound candidate for 2023. Roku's financial numbers may be moving in the wrong direction, but the underlying business still looks healthy even as it faces macro challenges. Usage numbers, for example, show solid growth in the most recent quarter with active account up 16% year over year to 65.4 million, hours streamed up 21% to 21.9 billion, the average revenue per user increasing 10% to $44.25. Those numbers all grew sequentially as well, showing that Roku continues to attract new users to its platform and increase time spent using its devices. This should drive long-term growth regardless of the current headwinds in the ad market. So, regardless of financial condition they're facing, they still have a lot of potential because uh, user average revenue per user and like active accounts and hours streamed. Overall, they all grew sequentially as well. So continues to attract users to its platform. Okay, most of Roku's business comes from advertising. Okay, and digital advertising is a highly cyclical business because companies can easily scale their spending up or down according to demand or their budget. Roku noted in its third quarter shareholder letter that there was a particular weakness in the traditional TV ad scatter market, which was down 38%. The scatter market refers to ad inventory that is not purchased early in the viewing season. How Roku performs in 2023 will be depend largely on the macro environment. If the Federal Reserve continues high interest rates and the economy slides into recession, it could indicate more trouble for the ad market and the streaming stock could fall even further. However, if we get a soft landing and avoid a deep recession, Roku still could soar on the rebound, especially if ad demand comes back. For long-term investors, though, next year's performance isn't the most important thing to focus on now. Connected TV continues to gain traction, and Roku is growing its audience and improving its product with the features like shoppable ads, which allows viewers to buy advertised products on Walmart simply by pressing the OK button on their remote. Hmm. The broad secular shift to streaming remains fully intact, and it is for this reason that we continue to invest and innovate. While Roku stock is likely to volatile in 2023, the sell-off looks like a good buying opportunity as the stock should bounce back when the macroeconomic environment improves. Okay. Tesla. Rivian's IPO was warmly embraced by investors, but production cuts sharply supply chain constraints, and which spooked the bulls and crushed the stock. Rivian will remain out of favor as long as investor rates keep rising. Rivian stock might have had a soft landing if interest rates were low and investors still had a healthy appetite for speculative EV stock. Unfortunately, soaring interest rates over the past year drove investors toward more conservative investments and punished unprofitable companies like Rivian. It's unprofitable, okay? Mm. Which racked up a staggering net loss of $5 or $3 billion in the first 9 months of 2022, while only generating $995 million in revenue. Mm. I personally believe Rivian is more promising than many of these backed EV makers that flopped over the past year, but until it successfully ramps up its production and interest rates stabilize, it will remain out of favor in this tough bear market. Mm. Okay. Warren Buffett is betting on a bull market in 2023, and so should you. Buffett's Berkshire Hathaway purchased several cyclical stocks in the third quarter. Buffett sees bear market as opportunities to buy quality stocks as a discount. Long-term investors are better off using the sell-off to buy oversold stocks and seeking safety in defensive stocks. What you might notice about the least above is that all eight of those stocks are in cyclical industries. If you were trying to prepare your portfolio for a recession, you'd probably be buying safe stocks in sectors like consumer staples, healthcare, and utilities, instead of areas like energy or materials. Not only did Berkshire buy only cyclical stocks in the recent quarter, but some of those purchases were in especially cyclical sectors. Okay. Hmm. Classic Buffett move. You might recognize this strategy if you're familiar with Buffett's philosophy. Rather than fleeing to safety, Buffett seems to be getting greedy just as others are feeling fearful. Buffett's conglomerate isn't buying these stocks because he thinks they will do well in a recession. It's buying them because he thinks they are cheap and sees them as quality companies that are oversold. In other words, it's preparing for a next bull market. For example, RH has solid track record of beating the market in the decade since its initial public offering and trade at the price to earnings ratio of less than 10. Louisiana Pacific, the world's largest manufacturer of warranty strand board, traded a P/E of less than 5, though earnings are expected to plunge next year as the housing market slows. Buffett isn't trying to predict what the market will do next year. He once outlined his thinking on that subject. Charlie and I never have an opinion about the market because it wouldn't be any good and might interfere with the opinions we have that are good. If we're right about a business, if we think a business is attractive, it'll be very foolish for us to not take action on that because we thought something about what the market was going to do. Buffett believes he's better off making sound investment for a long term rather than shifting his portfolio to defensive stocks to ride out a recession. It makes a good point. While most economists expect a recession next year, hmm, debating the market direction is much more difficult. Timing the market is generally a fool's errand. The stock market is a leading indicator. After all, it rebounds before the economy does. So it rebounds before the economy does. So it's a mistake for investors to sit around on their hands waiting for a recession to be declared before going out and buying stocks. Buffett's lesson is really clear, right? For long-term investors, you're better off using the bear market to buy quality companies, trading at a discount, positioning yourself for a next bull market rather than a recession. That doesn't mean there's anything wrong with buying safe stocks. Still, many of them are trading at a premium right now, meaning you're probably better off avoiding them unless you have a shorter time horizon. If you're looking to take advantage of the sell-off, there are some gems in Bush's recent purchases, and some other Buffett stocks are on sale as well, like Amazon. It's time to take advantage. Okay. Uh, okay, this is it for today. I did really short because I'm hella tired. Okay. I'll see you guys and hope you have a good night, okay? Bye bye.